Good afternoon, everybody. Chuck Hughes here. I wanted to talk today about the weekly option market neutral strategy. That's a strategy that's been performing very well in this kind of market. And I want to start off by just showing you some slides. This is different time periods of the S&P 500 index over the last 3 years. And we've had, most of the time, we've had no or little trend in the S&P, but a lot of price volatility. So if you're a directional trader and you buy a stock or you buy a call option or you buy a put option, you can really get chopped up in this kind of market where it's not trending, and there's a lot of price volatility, daily price swings like we had today. So the goal of the market neutral strategy is to be on both sides of the market with weekly options. And
hey Chuck, can you share your computer with us?
Oh yes, I thought I was, Tom.
Thanks.
Can you see it at all?
Not yet. Just go ahead and share your desktop, and we'll be able to hit you up.
There we go.
Love that picture, Chuck.
Yeah, that's a picture of the neighborhood here. But you could hear me okay, right? Okay. So what we want to do in this type of market is trade both sides of the market and take long and short positions in the same index. And you can profit in this kind of market. And I'll show you my actual profit results here. So what I'm going to display here is just a few snapshots of the S&P, and what these have in common is they're different time frames, but the S&P is virtually unchanged over these various time periods. But you can see a lot of price volatility, a lot of price swings. So it's just very difficult to make money as a directional trader in this kind of market unless you're really short term. So here's a snapshot of last summer. This is 2010, and again you can see a lot of wide price swings, a lot of volatility, up and down movement, but the index is virtually unchanged. Here's a more recent one, and again, price volatility and S&P just about unchanged over the last 4 or 5 months. So what I've been doing is trading a market neutral strategy with weekly options. And there's 2 ways to do this. You can, the goal is to position yourself on both sides of the market each week. Every Friday, you want to take long and short positions on the same index so that the underlying price of the index is pretty neutral. In other words, you can buy a bullish ETF and write a covered call against it, and then you can buy a bearish ETF on the same index and write a covered call against it. So you're positioned on both sides of the markets, and these are covered calls. And what I try to do is I try to buy approximately equal dollar amounts of the bullish and the bearish ETF so that the underlying price isn't changing that much, but you're short a call option for both the bullish and bearish ETFs. So you're on both sides of the market, and that's what is known as a market neutral strategy. So that's one way of positioning yourself on both sides of the market. The other way would be to sell weekly calls and weekly puts on the same ETF, which again can allow you to profit if the market goes up or down. And each week I roll over these short calls or puts to the following week, and I usually roll over either on Thursday or Friday and set up for the next week. And this strategy has been working really well in this kind of a market. Now, I'm collecting about 2 to 4% or more in option time premium each week for both the bullish and the bearish covered calls. So let's say I buy a small cap ETF, bullish small cap ETF. Then I sell a call against it. Then at the same time, I'll buy the small cap bearish ETF and sell a call against it. So I'm positioned on both sides of the market with these covered calls. And of course, if you sell an at-the-money call, that's all time premium. And of course, that time premium becomes profit a week later at option expiration, regardless of the price movement of the underlying ETF. And I'll show you some examples of that. So the nice thing about using the weekly options for this market neutral strategy is that you get 52 opportunities each year to sell option premium, and that can lead up to a 200% cash-on-cash return, regardless of the price movement of the underlying ETF. So in other words, if you invest $5,000 in an ETF at the end of the year by selling these weekly call options, you're going to collect $10,000 in some cases of cash over the course of the year on a $5,000 investment. So you can, the rich option premiums allow you to do this. And if you do this week in and week out like I do, it really adds up over time.
Chuck, a question
Yeah.
for you. The market neutral strategy and the market neutral spreads, many people think and investors think that it's something that's really related to institutional trading, and the retail side can't get involved, and you need too much money to do these type of strategies. Can you comment on that?
Yes, yeah, that's a great question. Usually when you think market neutral, you think of something really complicated and requires margin, and it's high risk, and you're short. But the way I do it, Tom, is by writing a covered call, a bullish covered call and a bearish covered call on the same index at the same time. So I'm actually positioned on both sides of the market with a covered call, which is fairly low risk, and I trade these in my retirement accounts. So to answer your question, the retail investor can do it, and I do it. So I'll show you some real-time results of what we're talking about here in a minute. So the idea is to be positioned on both sides of the market with covered calls. Here's an example of the small cap ETF, and I own the bullish ETF and the bearish ETF at the same time. So each Friday I sell call options against the bullish ETF and against the bearish ETF. Here's an example. This was selling a 21 strike call at $1.15. So that equates to a weekly premium of 5.4%. So I'm collecting a 5.4% weekly premium on this ETF. And if I get a similar premium and do that over a 52-week period, I'm collecting a 280% cash-on-cash return. And again, this is using covered calls, and that's a pretty high return, cash-on-cash return, and that can allow you to make money in the worst possible situations. Here's the math on that. And this is selling. Here's a different week that I sold 36 of these. In this case, it was the 22 strike calls at 122. So and the ETF was trading at 21.84. So if I sell the 22 strike call and the ETF is trading at 21.84, that's the at-the-money call, and it's all time premium. So this $1.22 that I received is all time premium, and that equates to a 5.5% weekly time premium that I'm collected with this ETF. And that time premium, you know, the time value, the option decays over the course of the week, and the option loses all time value at expiration in 1 week. So that, if you're short that option, of course, that becomes all profit. So I'm getting a 5.5% time premium profit on this ETF each week, and I get to keep that money no matter what the price of the underlying ETF does. And if you multiply that 5.5%, again, by 52 weeks, you come up with a 286% cash-on-cash return. So if I have $2,200 invested in this ETF, I'm going to collect over $4,400, closer to $5,000 in cash on my $2,200 investment. So that just shows you how much you can collect over the course of a year with these weekly options. So again, if you're collecting a 2 to 4% per week in time premium, a lot can go wrong, and you'd still would show a profit. If you had bad timing on when you enter a trade, it's not really a factor because you're positioned on both sides of the market. So, and the other thing is with these market neutral spreads, these volatile price swings allow you to take profits as early as Monday or Tuesday. So in other words, you write this covered call on Friday, and when you get these price swings, you can exit your covered call or exit the short option as early as Monday or Tuesday. And that happened this week because I exited when the market went up this week. I exited my long side of the covered call and kept the short side, and then today I closed out the short side. So I was able to profit on both sides of the market this week with these volatile price swings, so they actually help this strategy. Now, even if the underlying ETF declines substantially, you can still profit. I mean, if you're collecting a 280% cash-on-cash return, that a lot of things can go bad, and you're still going to make money. So even if the underlying ETF declines substantially, you can still profit with this strategy. Now, one of the reasons why this strategy is so lucrative is because the weekly options provide a lot more time premium than monthly options. And I took a snapshot. This is of MasterCard, and at the time, MasterCard was trading at $457.58. So the at-the-money call would be the $460 call. So at the time, if you were to sell the weekly option, you would collect $1,190 in time premium, because again, this is a at-the-money call, and that's for a weekly option that had 4 days to expiration. And the if you were to sell the July call, monthly call, on this same time period, you would have gotten $23.50 to sell the July. This was back in May when I took the snapshot. So if you sell the July option, you would have collected $23.50. If you sold the weekly option, you collect $11.90. So you're going to collect about 12 of these weekly premiums which would provide 142 points of premium versus over the same time period getting 23 points for the monthly. So the weeklies provide up to 6 times more premium than trading the monthly. So that's one of the reasons why this strategy is so lucrative. Here's another example. This is for American International Group, and weekly call, at the money call, was trading at 71 cents. The August call was trading at 231. So you're going to get to sell 16 of these weeklies over that same time period as you would for the August option. And with the weeklies, you're going to collect over 11 points of premium versus 2.39 for the monthly. So you can see that the weeklies provide a lot more premium over the same period of time. Now, when you have market neutral spreads on, because you're positioned on both sides of the market, the market neutral covered calls, they work best when the underlying index is flat for the week. And if the index is flat, then you just collect the premium. Losses occur when the underlying index makes a large move in either direction. So what I found through experience is if you sell out of the money calls and out of the money puts, depending on which strategy you're using, you'll have a higher percentage of wins because the index can make a large move either up or down, and you can still profit if you're selling out of the money calls or puts. So what I do is I use historical data to select these out of the money strike prices, and that allows me to profit even if the underlying index rallies 8 or 10% or declines 8 or 10% for the week. So even if you have an 8 to 10% move, you can still profit if you're selling out of the money options. So, for example, if an index moves 6% per week on average, then you want to sell an option that's 6% out of the money, and that allows you to profit if the index makes that 6% move in either direction. So by selling the out of money calls, you're allowing that index to move quite a bit, and you'll still be profitable whether it moves up or down. So, for example, if you have a covered call trade on an index, and let's say this was the bullish side of the index, and the index declined 6%, if you sell an out-of-the-money call, you can still profit on that covered call, on that bullish covered call, even if the index declines 6%, because you're selling out-of-the-money calls, which allow for a bigger move in the underlying index. And by using this historical data, it produces about 80% accuracy for these market-neutral spreads. So here's where it gets really interesting. If you use a profit target to close out your short options at 85% of their profit potential, this can increase this accuracy greatly. And you'll get closer to 90 to 95% accuracy by simply exiting these short options at a profit target. So let's say you sold a call option at 2 points on Friday. What I do is I enter a GTC order, good till cancel, to close out that option I sold for 2 points, to close it out if it gets down to 30 cents, because that's 15% of the entry price. So the most you can make when you sell a 2-point option is 2 points. So I'll gladly close that out if I reach 85% of that profit potential. And here's a good example of why this works so good. June 1st through June 8th, was the biggest rally of the year for the major stock indexes. And the indexes I trade in this market neutral strategy, they had an average rally of 11.4%, but because I used these profit targets in the market during this period, June 1st through June 8th, I was able to close out both my long and short positions at these profit targets, and over 90% of the trades were profitable. So normally if you have a move of 11.4% in an index and you have a market neutral strategy, you're going to lose money. But because I use these profit targets, over 90% of the trades were profitable. And I'll show you those actual trades here in a minute. So again, an average move of 11.4% in the underlying indexes normally would result in a profit for the bullish covered calls and a loss for the bearish covered calls, and an overall loss for the week. In other words, if you have an 11.4% move in either direction, you're probably going to lose money that week. And again, you'll make money on the bullish covered calls, but the loss on the bearish covered calls would probably exceed that, and you'd have an overall loss for the week. So during this week, June 1st through June 8th, because I use these profit targets, I would just wake up in the morning and, all of a sudden I'd be out of my position. And this gave me 91% accuracy, and it produced a $26,000 net profit after commissions for that week, even though the index rally, the average rally in these indexes is 11.4%. I still had 91% accuracy, and I had a $26,000 net profit after commissions. And here's the actual closed out trades for that week. And this was in two of my retirement accounts. And this account had a $16,000 profit after commissions with the covered calls. And this account had a $10,000 profit. And again, even though there was a big move in one direction, I still had a good week by using profit targets and exiting the short calls at an 85% profit target. In other words, if the short call reaches 85% of its potential profit, then I exit. Here's another example. This was the June 16th weekly options, and with those options I made an $11,000 profit after commission. And again, I'm showing the closed trade results here for that week. This was the June 16th calls. Now, this week, as I mentioned, the market moved up earlier in the week, and then of course today the Dow was down 250 points. But I had these profit targets in, and I was able to get out of my bullish positions earlier in the week, and then just today I was able to get out of my short positions. And most of I'm showing the actual closed trades. Some of these were closed out today, some were closed out a couple days ago. But again, the strategy produced over a $16,000 profit after commissions, and that's as of this week, as of today. And here's my other account. So overall, this strategy has been doing very well in this kind of a market, because you're taking advantage of these price swings and you're on both sides of the market. So when you do that, you can really make out well in this kind of a market.
Chuck, a question for you. When you are getting involved in the ETFs, for example, the SPY or the SH, do you try to correlate certain ETFs to trading congruence or exactly inverse from each other, or does it not matter using this strategy?
That's a good question. Yes, to answer the question, Tom, is if you're long let's say the small cap, well, let's say you're long the S&P index, you want to be short, you have a short position in the same index. In other words, there should be a direct correlation between the long and the short. Now, if you have roughly equal dollar amounts in your bullish covered calls, and you have equal dollar amounts in the bullish and bearish, then the underlying move in the ETF is not going to matter that much, and you simply roll over your short options every week. And that's what I do. I just hold the covered calls. I hold the underlying ETF, both the bullish and bearish. I have roughly equal dollar amounts, and I simply roll over the short calls each week on Friday. And then, of course, exit at profit targets during the week if the opportunity presents itself. So, yes, you want to have, you want the index, the long and the short position to be on the same index and correlated to the same index. Great. And let's just talk a minute about the super portfolio. I just wanted to update everybody on this, and I think I mentioned this in our last webinar. And basically, with the super portfolio, we're buying stocks and ETFs that are performing well, despite Europe and the slow-growing U.S. economy, and then we sell weekly call options against weaker sectors. And this spread strategy allows you to profit from price appreciation in the best performing stocks, and then at the same time also profit from selling weekly calls with weak ETFs or sectors. So this is kind of like a spread strategy where it's you're long the strong sectors and short the weak sectors, and this has also been working out well in this type of market too, because these super portfolio stocks have been holding up fairly well. Now, the super portfolio spread is not a covered call, and you're selling naked options, so it requires a margin account, and it's a little different than a covered call in that you're short a naked option. But the plus side of that is when you're short these calls, it doesn't place a limit on the profit potential of the stock. So if you're long Apple stock and you're short the Europe index, if Apple stock really moves up in price, it's not going to cap your profit potential on the underlying stock like a covered call would. So let's look at an example of an actual super portfolio stock that I have. This is for TJ Maxx, and I have a 41% profit on my TJX Max stock, and at the same time, I've been profiting from selling call options on the Europe, China, and energy ETFs. So when I sell a call option, let's say on the Europe ETF, that doesn't limit the profit potential for the TJX stock. So in other words, if that TJX stock moves up 10%, it's not going to be capped as it would be in a covered call when you're short these indexes and ETFs. So that's one important difference between the super portfolio and covered calls, in that you don't cap your profit potential on the stocks. So let's look at some examples of super portfolio trades. And again, I've been trading these super portfolio spreads in real time, and these spreads are holding up well too in this type of market. So the typical super portfolio stock is in a confirmed price uptrend using our trend indicators, It has little or no correlation to European economies or debt, and it's not dependent on the price of oil or commodities, which are collapsing because of the global slowdown. And these super portfolio stocks typically have strong growth rates, even in a slow-growing U.S. Economy, and they're in leading industries. And as I mentioned, I own TJX stock, and we can see that the blue line here is the 50-day EMA. It's above the 100-day EMA, so TJX obviously in a price uptrend. It's been making a series of new 52-week highs, which confirms this price uptrend. And you can see the on-balance volume line is also sloping up, confirming this price uptrend. So TJX is in a confirmed price uptrend, has little or no correlation to the European debt crisis. TJX is not dependent on the price of oil or commodities, and it has strong equity and retained earning growth rates despite the slow-growing U.S. economy. And TJX is in a leading industry, retail. So I have this in two of my portfolios, and currently have a $67,000 open trade profit for TJX stock. And at the same time, I've been profiting by selling call options each week. And for TJX, I've been selling call options, the Brazil call options. And here's a snapshot of the Brazil index. And you can see that Brazil is in a confirmed downtrend because the 50-day EMA is below the 100-day EMA. It's been making a series of new 52-week lows, and the on-balance volume line is sloping down. So the idea here is you own TJX stock, which has been performing well, and you're short calls for the Brazil index, which is in a confirmed price downtrend. So here's an example. I sold 21 of the Brazil 57 strike calls, collected $1,909 in cash income, and this was for a weekly option sale. And I get to sell these call options 52 weeks a year, and as we saw in the case of the market neutral spreads, with the super portfolio, you also get to collect a lot of time premium over the course of a year. So this allows you to compound your returns very quickly. And as I mentioned, the time value portion of an option becomes profit when you're short that option at expiration because the option loses all of its time value. So let's look at the potential cash-on-cash return for selling this Brazil index call option. The Brazil index, at the time I took this snapshot, here's an example. I sold short 13 of these are the May 19th weekly calls at $1.05. So if EWZ was trading at 56.95, I sold the 57 strike call at 105. That would be the at the money call and would consist of only time value. So that 105 points becomes profit at option expiration 1 week later, no matter what happens to the EWZ ETF. And what I like to do is if I'm selling the 57 strike call, then I like to have an equivalent amount of stock, super portfolio stock. So if you're selling the 5,700 strike call, then you'd have roughly $5,700 worth of stock for each one of these calls that you sell. So it sets up a spread, and you're short an equivalent amount of Brazil call options, the value of it, compared to the stocks that you own in the super portfolio. So I sold 13 of these 57 strike calls. So that's the equivalent of about $74,000 worth of stock. So selling these 13 calls covered about $74,000 worth of super portfolio stock. So if I did this each week and I was able to get a similar time premium, then I would collect over $70,000 over the course of the year, divided by my stock investment of $74,000. So that's about a 94% cash-on-cash yearly return for selling this call option. So even if the underlying stock declines in price, or even if this, I should say, even if the super portfolio stock declines in price, and you're collecting 94% cash-on-cash return, you can still be profitable with these spreads. And another thing I do when I roll over these weekly options, both for the market neutral and for the super portfolio, I'm collecting a lot of premium, and that allows me to compound my returns, because I roll over the options, and each week I'm collecting more income, and that in turn allows me to buy more stock and write more covered calls. And another thing I do with these weaker indexes is I'll have a profit target in there, and I may sell a call option on Friday, and my 85% profit target could be hit on Monday or Tuesday, just a couple trading days later. So when that happens, then I close out the option. And here's an example of I bought to cover those 21 57 strike calls at 13 cents. So I sold them at $1.05 and 72 cents, bought them back at 13. So I made a profit on that. Then I went ahead and sold another 21 calls, and I collected another $1,261 in premium. So you're able to, if the index declines in price over the course of the week, you close out your short option and then write another option, and you can collect several of these premiums inside of a 7-day period. So, and then I actually with this the Brazil 55 calls that I sold, I actually bought those back, and then I sold another. I sold the 53 strike calls. So I actually had 3 trades in 1 week with this Brazil index, and they brought in a total of $4,007 in time premium over the course of 1 week. Here's another example of a super portfolio stock. This is for American Capital, and this is a real estate investment trust that invests in government-backed mortgages. You can see American Capital's in a price uptrend, the 50-day EMA above the 100-day EMA. It's making a series of new 52-week highs, and we have an upsloping on-balance volume line. So American Capital's in a confirmed price uptrend. It has no correlation to the European debt crisis. It's not dependent on the price of oil or commodities, and it's had a strong equity growth rate in a slow-growing U.S. economy. So American Capital's been performing well in this type of environment, and I have $38,000 open trade profit in American Capital. And one of the nice things about this stock is it pays a 16% dividend. And it's actually about a 20% dividend for me because I've owned it for a while, and I've been reinvesting the dividends in additional shares. So American Capital just went ex-dividend this week, and I'm going to collect about $10,000 in dividends off of this stock position. And with my American Capital stock, I've been selling call options on the China ETF, symbol FXI. And we can see the FXI is in a confirmed price downtrend. And these are my brokerage confirmations over the course of a week. And I sold and bought back these China options 3 times inside of 1 week. And I collected $5,600 in time premium for FXI. And with the FXI, with the ETF trading at 34.96, sold the 35 strike call at 75. So that would be the at-the-money call. Again, all time value becomes profit. If 1 week later, option expiration, so collected $882 of time value profit. And the selling 12 of these 35 calls is equivalent roughly to $42,000 of super portfolio stock. So if you get a similar time premium each week times 52 weeks, you're going to collect $45,000 in time value premium over the course of the year versus your $42,000 investment in the super portfolio stock. So again, you're going to get over 100% cash on cash return by selling a similar premium each week. So again, a lot can go wrong with the super portfolio stock, and you still make money with this trade. Now, with smaller accounts, with the super portfolio, let's say you were going to sell one of the China ETF 35 strike calls, you would invest a roughly equivalent amount in stock. So selling the 35 strike call, you'd purchase about $3,500 in stock. And you could divide that up between 1 or 2 or even 3 of the super portfolio stocks, because this is not a covered call, so you can vary the amount of stock you own. And just keep in mind, you need a margin account to sell these naked ETF calls. And here's a snapshot of time premium I sold over the course of a week. And this is for the May 19th weekly options. And that week I collected over $28,000 in premium. This lists the premium I received. And this is actually the dollar amount that's credited to your brokerage account as you sell these options. So over that week, I sold $58,000 of time premium. Now here's this is a pretty good gauge of how this super portfolio has been performing. Here's a snapshot of my closed trades. In other words, these are the May 19th weekly calls. This is for the emerging market index, Europe index, Brazil index. These are my actual closed out trades, and this report lists the closed trade profit or loss in this column right here. So for these May 19th options, I had net profits of over $24,000, and that's after commissions, and that's in these 2 accounts. So this week, I collected over $24,000 in profit, but over that same week, the super portfolio stocks were actually up, and they had a positive 0.75% return over the same time period. So I profited from the closeout of these short calls here, but I also profited because the super portfolio stocks actually rose a little less than 1% that week, and that was a pretty brutal week, that May 19th. So I not only made money on the short calls, but I also made money on the super portfolio stock. So that shows you how you can, make money in these kind of market conditions. So we're trading the super portfolio now with my weekly option advisory, and it has about a 48.8% return year to date. So these are just snapshots I took of the super portfolio versus some indexes, and you can see in this snapshot the indexes for the year were down 3%. Super portfolio stocks on average were up 31%. So these are just snapshots I took I took both snapshots at the same time, is what I'm trying to say. So on this day, the year to date, the indexes were down 3.9%, but the super portfolio stocks on average were up 33%. So again, you're long the strong stocks and you're short the weak indexes. So that concludes my presentation for today. If you want to see the trade results for the weekly option advisory, just log on to weeklyoptionalert.com and click the trade results, and you can see the recent trade results for the advisory service. So at this point, I want to thank everybody for attending, and I'd be glad to take any questions.
Chuck, how often with your weekly option advisory do you get signals on this particular program?
Now you're talking about the super portfolio?
Correct.
Okay, super portfolio, there's weekly signals because what we do is we roll out of the short call option that we have. So each week there's going to be, right now there's 8 spreads, so each week there'll be 8 rollovers and 8 trades for the super portfolio, and we'll be rolling out each week. Now the number of spreads in the super portfolio can vary, but depending on market conditions, but right now we have 8 stocks in the super portfolio.
Any specific days that you'd like to focus on, or is it really dictated by the market? Do you like to go closer to the end of the week for options expiration to try and squeeze some more pennies, or do you stick with your targets?
Well, we would stick with our targets, and if the targets aren't hit, then we would roll over either on Thursday or Friday to the following week's weekly option.